Everybody, welcome to the meetup. Let's see. Tyler, Ted, how you guys doing?
Ted is good.
Doing great.
Hey guys, what I'm going to do, we're turning these into podcasts. So what I'm going to do is just sort of do like a little intro like it would be a podcast. So yeah, so we'll just save all the Q&A to the end and we'll kind of cut it off. You guys good with that?
It's a good idea. Love that idea.
Awesome. Tonight, I'm just going to just rock and roll. I'm going to just start talking fund to fund, and then we'll get to the end, and then we'll open it up for questions. So, all right. Anything?
Do we have some people on? Because I can't see it.
17.
Oh wow, that's good.
17 registered. So,
Wow.
I don't know who's on now, but oh, you know what? I'm going to pause the recording. Okay, so tonight we're talking, welcome to the Investment Syndication Simplified meetup. We've got a good topic tonight, fund to funds. My name is Ryan Gibson. I'm the CIO of Spartan Investment Group and the co-founder of Investment Syndication Simplified, which is a meetup that focuses on passive investing. So just a real quick background before we start. The reason why we started this group is because we wanted to increase investor sophistication. We wanted to create better networking opportunities, look at quality offerings, and conduct project site visits on real live projects that were syndicated through passive investments. So we have a little mission to enhance passive investor knowledge in the greater Puget Sound region. This group is a podcast, it's a meetup, and pretty soon, hopefully, it'll be face-to-face when we can meet together. So we'll do these live to kind of do a nice networking experience. The next part is, we kind of go over what is a syndication for those that just joined this for the first time tonight. Welcome. A syndication is essentially a pooling of investor capital and partnering with an operator to take down a 300-unit apartment building or 1,000-unit storage. So some people think that, I got to have, decades and decades of experience and millions of dollars to invest in an apartment building or storage or an industrial warehouse or an RV park or something like that. But the reality is with the syndication, it gives you direct access to real estate, commercial real estate on an asset that you may not take down or want to take down all by yourself. So it allows you the opportunity to partnership with an experienced team. And people can syndicate things, everything from a single family home to a multifamily apartment building to a self-storage. And I've heard syndications happen on Broadway shows. So tonight we're talking about fund funds, and the kind of setting the stage here is I wanted to talk about my company for a minute and what we do in syndications, and I think it'll really add a lot of flavor and context to what we're talking about tonight. So we're kind of a small company, small to mid-sized syndicating company, and we do commercial real estate primarily in self-storage. So this is a kind of snapshot of where we are today, about 5,500 units under management, 30 employees, 110 million in projects underway. We have about 236 active investors, about 1,900 in our network, $30 million of private equity raised, and 9 completed projects. So a fund to fund can actually partner with an operator like a company like Spartan. So we get check sizes anywhere from, where we have to do deals that raise anywhere from, $1 million up to potentially $15 million. And when limited members come into the partnership, we have a network of investors that invest $50K or $100K or $500,000 at a time into syndication, but there's also limited members that come in that are fund funds. And a fund is essentially a group of investors that kind of get together and they pool capital and invest as a limited partnership to get a better promote on the or a better split or a better return and invest passively still in the syndication. From an operator standpoint, they're a limited partner. So there can't be any compensation from the operator to the limited member or to the fund to fund. And the deal has to be, they're not part of the co-GP. We kind of think that the co-GP is kind of a gray area, especially if the co-GP is just bringing in the capital to do the deal. They're kind of just getting paid to raise money. So a fund is a nice, clean way of basically, if you have friends and family that want to invest passively and you want to put together a fund to fund, that is one avenue to sort of get your real estate business going. Likewise, there's institutional fund to funds that will write big check sizes, anywhere from 3 to 50 million to do a project. So registered investment advisors will come in, and they may have a book of clients, and they may be looking for operators to partner with to do fund to fund. So there's everything from a guy that's raising as little as 500,000 in a fund to fund to big institutional groups writing bigger check sizes. So the next slide we talk about. So what is a fund to fund? So if you think of a syndication, you can have kind of two different ways this works. So I know a lot of operators that say, I want to create a recession-resistant fund, and so I'll give a shout out to a broker, right? A mortgage broker or a commercial broker that sources deals, right? If you are looking for the best debt or looking for someone to leverage relationships with, you go to a mortgage broker, or you go to a real estate agent, or you go to an insurance broker. And those are the folks in the market that have the connections to get what you need the most efficiently. So when you have a fund to fund manager is doing the same thing in syndications. So there's fund to fund people out there that all they do is they vet operators, they vet the companies that are doing these syndications, and they find places to place your money as an investor into deals. So you may be running around, you don't have enough time to do all the due diligence, or know, hey Ryan, who do I put my money with? Well, a fund to fund manager or a fund to fund company might be a good solution for identifying the types of investments that you might want to do, because they have gone through all the underwriting. They have met with the sponsor. They have conducted background checks on the sponsor. They've asked for bank statements. They've asked for all kinds of things that would bona fide that person or that company as a good operator to do business with. You don't have time to do that, or maybe you don't have the experience to know the types of questions to ask. So you might ask, what's the benefit of a fund to fund as a passive investor? And that is one benefit. I probably wouldn't try to sell my house by myself. I would probably go hire somebody who knows how to do it, right? Or I probably wouldn't try to go, when we source our commercial debt on our properties, we use brokers. Brokers have relationships in the markets that are hard to replicate. We're busy finding the deal, funding the deal, operating our business plan. We leverage relationships in markets to find the best source deals. Now, the broker has to be compensated for that. And that's part of what a fund does. And what we're going to do tonight is we're going to talk about how a fund manager might pay themselves, how they make money on split. And maybe if you're thinking in the back of your head, wait a minute, I could probably do this. I have high net worth individual people in my market. I could probably go explore how to set up my own fund to fund, or start learning the process to do it correctly and legally. So kind of the first icon I have here is blind fund or special purpose vehicle. So there's kind of two ways funds work. So if you're a passive investor and you go to a fund to fund, they may say, hey, I have a open fund that's a recession resistant fund, let's just say. And that may target recession resistant asset classes. And it could be a variety of different operators that they know, and it could be sort of a blind pool. So the operator might be doing mobile home parks and storage, RV parks, recession-resistant type asset classes. So they may be doing it through multiple operators. So you could they may have deal flow all the time. And that fund-to-fund manager has vetted the operator. So you invest with them. They have, kind of a blind fund. So you don't really know that it's a specific property that you're investing in, but you know the type of asset class that your money is going to go place in, and you kind of have the parameters in the PPM, the operating agreement, that talk about the types of funds that fund targets. Then you have a special purpose vehicle. Special purpose vehicle is the type of fund to fund where it's saying, hey, we're investing with this operator, this deal, this asset class, this address, right? So the offering that we just did on Tyler Longview, fund to fund came in, and they raised capital for that specific deal. So, a fund to fund has an investor network, just like we do. We source some of our, most of our deals just by ourselves. And we are starting to work on relationships with fund to funds because we're going after $50 million to $100 million portfolios, and we may not be able to take down all that raise ourselves. So we work with fund to funds. And again, it ranges from folks that are just starting companies to RIAs and companies that have big checks to write on projects. So you identify a syndication, identify an operator, and then you invest with that operator, either the limited member or limited partner. And then that fund, as the waterfall and the money comes out of the deal, that fund goes to that limited member fund to fund, and then the money gets dispersed based on how that fund has set up their structure. And we'll talk about some different structures this evening. So again, type of investments in a fund to fund, pretty much everything: mobile home parks, RV parks, storage, real estate developments. They can pretty much place money in any type of private syndication. So how to build a fund. So if you're thinking, hey, how do I get started with this? Usually fund managers have some kind of thought leadership platform. So if they're targeting self-storage assets, they're going to talk about self-storage. They're going to talk about mobile home parks, whatever they're talking about. They're going to have some sort of education platform that engages their investors with the type of deals that they do. They're going to be out in the world networking and marketing, providing thought leadership, and then they're going to ultimately want to provide you with quality opportunities that they've vetted. That's supposed to be what they're doing, and then they identify great operators. They might do a variety. They might have their own podcast or webinar. They will go and do open houses at properties that they've helped take down, and they provide investor education. So a fund to fund still has what we have when we do a securities exempted offering. They have an operating agreement. They have an offering memorandum. They may take the offering memorandum from the operator and reposition it to their own branding. And they do a private placement memorandum, and they do the whole process. So you are subscribing to their offering just like you would subscribe to a company like Spartans directly. So it's just, the paperwork is very, very similar. So, just to kind of give you an example, this was from our last offering where we had multiple classes of investors. We had class A, B, and C. So tonight we're going to focus just on the class C over to the right. So class A members receive a split based on being a first-time investor under 50K. Class B were repeat investors who got a little bit of a bump in returns because they were repeat Spartan investors. And then Class C members, that was for people who invested over $500,000. So for Class C investors, we had that was for investments over $500,000. So investments over $500,000 are receiving a 20% bump in ownership. And because of that, their returns go up. So an investor who goes through a fund to fund might, is probably going to be a Class C member because they're going to raise that fund to fund is incentivized to write a bigger check for the offering, and they get a bigger percentage split and more of the deal. So you might ask, okay, so they make more. Why would I go into a fund to fund when I could just invest directly with the operator, right? Well, it's kind of what I explained at the beginning. They're doing the vetting, they're doing the branding, they're making sure that the investor is or the operator is a good operator, and they're sourcing these opportunities. You may say, hey, I've done everything I want to do in multifamily. I want to pivot to storage or RV parks or mobile homes. Who's doing that stuff in space? And you may find a fund to fund that is doing all the work and has all the connections to the operators and has the relationships to provide you with a quality opportunity, right? So it may be something that you never knew about. Admittedly, 5 years ago when I started investing passively myself in other people's syndications, I really wish I had found a fund to fund, to be honest with you, because I didn't really know what I was doing. frankly, I was an unsophisticated passive investor. I made a couple of investments that were not good investments. And, a fund manager that's worth their weight in gold will kind of help vet that process, right? And so you want to make sure you understand the quality and the opportunity that fund manager is providing you. So just something to think about. I'm not saying that I guarantee that the fund manager has done their job and has vetted the operator, but good ones are really can be valuable to your investing career. So in this case, like I said, we're talking about the Class C members. So minimum investment for the Class C members into our offering was $500K. But the fund-to-fund might say, hey, our minimums are only $5K or $10K or $25K. And they got a 20% bump in ownership. And the fund-to-fund stands to earn potentially $84,000. So let's take the passive investor hat off for a minute and just say, okay, if I was going to invest in if I was going to start my own fund-to-fund, how do I get compensated? So the earning potential for a fund-to-fund here could be $84,000, just one way of doing it. And this isn't the way that they did it or anything, but this is actually just a kind of an example of what a fund-to-fund could do. So here we go. This is a breakdown of a raise. Total raise was $4 million, which is $50,000 shares. A Class A member would have received 0.6% per share. And that would have ended up a 48-52 split with the limited members and the general partners. Okay, we're just, hypothetically follow along with me. Class B is a 0.63% share. They receive a 50.4-49.6 split. So basically a 50-50 split. That was a 5% premium over what a Class A member got. That was for being a repeat investor. Class C goes to 0.72, which is a 20% bump over the ownership of a Class A member. So that bumps up the split in the partnership to about 58, call it 60-40, right? So then when we drop down here below, we get into the fund-to-fund structure. So now this is the fund-to-fund that came in, placed, in this instance, they placed $850,000 into the deal. But in my example, let's just say they placed $500,000. So they took the additional equity that we gave them for placing that $500,000, and they took all of the upside of what the 20% bump. So instead of getting, they basically said, hey, the pref was 7%. We're going to give the pref to our investors, but the 20% premium in the ownership, we're going to keep that as a way of organizing this fund-to-fund, right? That's the way they set it up. So what they did was, let's say for this example, they took 83.33% of the pie in the new fund-to-fund, and they took 16.67% of the fund-to-fund, and the limited members got 83% of it, which is the same thing as going to Class A share. So when the limited members, the returns here on $500,000 investment are $421,000 earned over 5 years to the limited members. And if the deal when it's proposed, they would get $84,000 to the general partnership. So remember on the previous slide, the profit on this deal is about $505,000 over 5 years on a $500,000 investment. So it's basically 2x your money in 5 years. And this is the way it breaks down. So they got $84,000 to the GP, $421,000 to the limited members. So when you say, okay, well, what is a reasonable amount of money to make on the money that I can raise in a fund-to-fund? So in this case, the fund-to-fund is earning 3.4% annualized on a $500,000 raise, or they're earning 16.8% per total return on the money that they're bringing in and raising for putting together a deal. So that's just pretty much just one way of doing it. Obviously there's many different ways of doing it. And if you're looking to set up a fund-to-fund, the first person I would talk to is an SEC syndication attorney or your legal team, and definitely get your fund structure set up correctly. If you need any recommendations on a fund-to-fund attorney, happy to provide that. But that's just one way of just sort of learning how the fund-to-funds work, and also kind of understanding the benefits of going to a fund-to-fund. And I hope you enjoyed this presentation, and we'll see you on the next one. But now we're going to go ahead and open it up to Q&A. Oop, I think I'm going to go ahead and share. Okay, so time for questions. I think I've got everybody unmuted. Hold on, let me just make sure. A lot of talk, a lot of talk, a lot of talk. All right.
Hey, thank you, Ryan. I appreciate the presentation. I got to take off.
Nice seeing you, Nick, virtually.
Yep. All right. Take care.
Bye.
Ryan, quick question. So I'm just thinking it was return on investors' capital 3.4% for the person who manages the fund, right? But technically, if the return is infinite, right? If they didn't put any money in and they made $84,000,
Yep.
they made more than 3.4%, correct?
That's correct. Yeah. You at some point, returns, have to be measured, and you have to kind of put in my opinion, you've got to put kind of a value on your time, and what's it take to get that kind of money in your network, or the vetting of your operator, things like that. It's kind of a KPI. It's a way to measure, hey, if I'm going to do this guy's deal, I could stand to make 3.5% per year on the money that I raise, versus this guy's deal might be 1%, and you might kind of think, okay, my criteria is I kind of got to see at least 2% per year, or whatever it might be. So that's kind of just kind of a way of looking at it. But absolutely, if you want to look at it that way, it is infinite, because if you don't invest, if you don't co-invest, it might be a good return. Or if you do co-invest, which I highly recommend, I co-invest in all of our deals. And I highly encourage, if you're investing in someone's syndication, understand that make sure that at least one of the principals is co-investing. And if they're not, make sure you understand why. And, there's usually, there's good and bad reasons, but, just kind of understand why they're not investing alongside you. So. Any questions on fund-to-fund stuff? I know it's kind of a, this presentation sort of, we're talking about people who want to start a fund-to-fund, but then I also wanted to make sure that we had the perspective of, why would a passive investor want to do this? And I hope I, kind of spoke to that value a little bit.
Ryan, this is Yuri. Quick question. Can you hear me?
Yeah, we can hear you. Hey, Yuri.
So if I know a syndicator that I want to use to invest my money, it seems like going through fund to fund will introduce an additional risk, because if you get a 20% in the premium going through Class C, and if I go through Class A or Class B, if I'm returned, and they're going to take 16% out of it, then I'm really not benefiting much financially. But it seems like going through fund to fund would introduce an additional risk, because you really have to trust the operator or the owner of that entity, right?
Yeah, and that's absolutely a valid concern. And that's kind of goes into if you want to increase your deal flow, you could consider looking for a fund to fund. But it's all about, you got to find a good one. You want to find a good fund to fund who's got a track record, maybe, or just you understand the work that they go through to vet the operator, because there is a chain of trust there. There's a chain of trust between you trusting the syndicator or the fund to fund to make an investment in the syndicator. And I want to expand on that a little bit. And I know Ted's here, and I don't know if he can jump in and help me a little bit if I don't hit this perfectly. But it's kind of like there are RIAs, registered investment advisors, who are fiduciaries that will find operators to place capital with. And my understanding is, you might say, well, I got to trust this guy to place money. But, with an RIA, that RIA has a fiduciary responsibility for your money. So if that operator isn't a good operator, that guy is could be personally liable for mistakes and for making the bad bet. So those RIAs really take a close look at, who their operators are, and the due diligence process is pretty extreme. Ted, do you want to add anything to that, or did I get it?
I think you got it nail right on the head.
How much do they charge the advisors?
So it depends on the regulatory authority that governs the advisor. SEC registered investment advisors and the parent RIA generally charge as an asset under management, and they'll take anywhere from 80 basis points to 125 basis points as a management fee on top of the asset structure. Some state registered RIAs have to charge on a billable hour, so you might ring up $3,000 or $4,000 just to have the deal presented, because the RIA's got to cover their tail on the due diligence process that they've gone through.
Thank you.
Ryan, I'm going to hop off. Thanks for the information.
Yeah. See you next time. We'll meet again in 2 weeks on Thursday, same time.
Great.
Doing a case study
Bye-bye.
next week. Bye. Okay, so good question. The cost to set up a fund to fund. So if you're looking to set up your own fund to fund, I would probably budget about $10,000 to set it up. It's probably a good, to get your, documents done and get your fund set up and marketed. It's usually about $10K.
Brian, I usually see this value proposition as like a division of labor opportunity. Like, hey, I just don't have any time, right? It's one thing is that I already know this guy. I know the projects he's done. I know I can underwrite the projects themselves, but it takes a while to get to know someone, right? And so you're essentially compensating somebody for doing the due diligence on the group or the person and doing a lot of background research and all of that stuff. But to give maybe some context around it, for me at least, how much time would you spend like underwriting a new sponsor for a deal, or like, in a particular deal? Because that's it gives a little bit of context for why you'd want to say, hey, I'd rather just have Ryan deal with even the underwriting aspect of it, because my time's too valuable.
Yeah, I'll give you the real example. So the CFO of Cardone Capital, of Grant Cardone's fund, was hired by the fund to fund that invested in our last project to audit our underwriting.
Wow.
And thankfully it came back very positively. Obviously they moved forward with the deal, but you wanna, and one of the ladies that was in that group was a professional underwriter for I think 10 years for a multifamily company. So it's time is valuable, but more importantly, the person vetting the underwriting was extremely experienced and knows what to look for and knows how to run a spreadsheet and knows how to run a pro forma. So, the time is important, but the quality is really important. Understanding that they've, gone through the rent roll, they've gone through the sources and uses, they've put together an underwriting file that's complete and satisfactory, is really critical. And a fund-to-fund manager either is going to do that themselves, or they're going to know somebody who can provide that service to audit the financials. So, that would be one thing I would ask a fund-to-fund. What have you done to vet this operator? And if it's a weak answer, then run. That's not a good fund-to-fund manager. If it's a, hey, we had an underwriter come in and do a third-party review, or I was an underwriter and I did it myself, or whatever it might be, the more that fund-to-fund puts that operator through their paces, the more value they've created for you to reasonably expect that the operator's been vetted. You always have to do your own due diligence. Of course, you're always ultimately responsible for your own investment, but that's something that you can get a lot of value to. Good question. Yeah.
Ryan, this is a very good one. I got another one, and this is something I learned over the expo that we've been over last week, Real Estate Expo. Kathy spoke, and she said that fund-to-fund managers, or if you be raising capital, like if I be raising capital from a group to invest in your deal, I have to be licensed. That's something that I learned in that, and I haven't had a clue about that before. What is about this license? What kind of license?
Great question.
Is that?
So to raise capital and be compensated for it, you have to be licensed. However, there's an exemption to securities law that allows you to raise capital from private investors as long as you file an exemption for unlicensed people. So they're called exempted offerings. So a syndication is essentially that. Now, I can't pay myself for raising money either. We pay ourselves project fees for running the deal. And then obviously we can take a split in the project. And this would be something similar. So fund-to-fund can be unlicensed people, but they have to be following the letter of the law, following the exemption, doing their blue sky filings, filing with the state, doing their Form D. Having an attorney prepare their paperwork correctly. So that's something you can do. But you're correct. Technically, an unlicensed person cannot raise money and be compensated for it unless they use the exemption and follow the exemption to the letter of the law. Ted, do you want to back me up on that a little bit? Anything to add?
Yeah, that is if you're not 100% confident in what you're doing, don't do it. It is a deep, big albatross that you don't want to be involved with. So, an engagement with a healthy attorney is, $5,000 to $10,000. But if you don't see documents that say 506B, 506C, things of that nature, Reg CF possibly for a smaller offering, don't walk, run, and I'll shut up.
Yeah, exactly. Yeah. And so, Igor, to answer your question, you don't have to be licensed if you follow an exemption, and that's where the attorney comes into play, and you talk to your legal team. So.
Hey, Ryan, this is Sonia.
Hey, Sonia.
Hey, I am curious. So where would someone learn more about getting licensed, or even just learning all the ins and outs of the exemptions, and if I wanted to start a fund-to-fund, how do I get started with that? Or how do I educate myself enough to even know what I would be doing?
Yeah, there's actually, there's a great class, and I can send you an email. If you follow up Ryan at Spartan-investors.com, I can send you a few leads on education spaces that do fund-to-funds. I really like the real estate guys. I really enjoy their podcast, and I enjoy their content. They do a Secrets of Successful Syndication, and that it's kind of funny. That conference is actually tomorrow. It's tomorrow and Saturday. So that's a great overview of, how this works, how to structure things, and, how to raise money properly. But there's some great programs out there on just kind of basic knowledge. But really, an attorney would be a great place to start as well. And I'm happy to share, some referrals on attorneys as well. But that's probably a good place to start. I probably, Ted, feel free to correct me if I'm wrong here, but I would probably, for being licensed, I would probably take the first step and just make sure that, you like the exemption, because you might find that might be the quickest path to progress. And very efficient. So instead of trying to go get what series is it, Ted? Yeah.
You can be a licensed security salesperson with either a 65 or a Series 7. Sonia, that you don't need all of that stuff. Take a month or two to do some learning and work with an advisor.
Yeah.
Cool. Thank you.
Shoot me an email so I don't forget to send you that stuff. I think.
Okay, will do.
I think I have your email.
Yeah.
So, yeah. I have a few links and good education formats and stuff like that.
Yeah. Awesome. Thank you.
Mhm.
Hey, Ryan, this is Nico. Can you hear me?
Yeah. Hey, Nico, how you doing?
Good, man.
Good.
Do you see most funds of fund of funds, people that are doing that, is it mainly registered investment advisors, or do you see a lot of real estate agents or just other investors that maybe are, they're done with their developments, they're getting older, they kind of just want to, focus on something else that's a little bit less hands off?
Yeah. So, I see the spectrum. So I see everybody from, what I like about it is, you might be thinking, I really want to do self-storage or multifamily. I have a network of folks I can raise money from, but I just don't want to be an operator. I don't want to go vertical and have property management and deal with the headaches and the development and all that stuff. But I do have a network, and I want to pool together and do syndications because I enjoy the due diligence and working with operators and things like that. So that's just a very quick path to progress on to setting up your fund. You have quite a bit. I wouldn't say quite a bit of that, but you have a lot of groups out there that do that. And I don't know who they all are, but then you have like the middle market stuff. Check sizes 3 to 5 million of investment shops that are licensed that do syndications and placements into that. And then there's just tons of RIAs. I mean, RIAs that organize capital into syndications. Ted, I mean, you probably have better. I mean, there's probably a trillion, maybe a billion out there. Probably more than that. I mean, what would you say in the RIA group world? How much money do you think annually goes into private placements?
It's a lot, but if you think about what the Fed has done to the stock market, I think that in general, it's not a lot as compared to what it's going to look like in 5 years, because bear in mind that just 2 months ago, the Department of Labor approved the allocation of 401k dollars or defined contribution plan dollars to the world of private investments. So it's going to be bigger 10 years from now by a factor of I don't know what, but it's big, but it's going to be on the come for decades, I think.
It's good to know.
Yeah.
How would you go about finding because I missed the first 15 minutes in terms of like finding RIAs or good RIAs? How would you know who's good at them or who does? Because I don't think all of them do that. They mainly maybe focus stocks, bonds, mutual funds.
Yeah. Can I jump in on that, Ryan?
Absolutely.
Yeah. So the TEL is ADV Part 1A, and that's a monster XML database that's hosted either with the SEC or the State Department of Financial Institution, the state in which the RIA is registered. But in essence, what you really want to do, ask a friend, do they do private investments at your shop? If your trusted friends aren't working with an advisor that does private placement deals, do a Google search, and then when you're talking to the advisor, ask what variety. Do you advise on storage? Do you advise on multifamily, et cetera, et cetera? Don't be in a hurry and look for a clean report card. Every firm has a report card with compliance violations, and you want to find more than just a 2 or 3 man shop that's got some depth to it and some history.
And Ted, what's that site you can go on and look up, how much money they have under management? What's that site you go to?
Yeah. So advisor.sec.gov. And you can it's a good place to get a brief snapshot of what the firm does. You want to look at section 5A for assets under management. You can just type in the firm's name and section 5A, and there's the assets that the firm manages.
Sorry, that was advisorinfo.sec.gov.
Yes, sir.
Okay, that's in the link. So I just messaged that to everybody. So it's a good resource. So if you find an advisor, you can look up how much their shop does too. I think that's kind of neat, how much volume they're doing. Because all that stuff has to be reported because they're registered. I like this discussion. I think this was kind of neat. It's a little bit, it's again, the group, we're trying to kind of broad brush. So, if you meet a syndicator and, well, that's just a syndicator syndicating for other people. It's like, yeah, that happens. That's a normal thing. And, these are the types of things that you would want that person doing on your behalf, to justify their role in the partnership and getting part of the split. Oh, thanks, Amit. Yep. There you go. Yeah, it's yeah, okay. So link was bad, so we are going to, there you go. That's correct. Thanks for the correction, Amit. Appreciate it. Yeah. Oh, good point, Nico. So I just wanted to let everybody know that we have a YouTube channel. And it's up on the screen. It's called Investment Syndication Simplified. We have a whopping 7 subscribers to this amazing event. This was the first time I actually put this out on LinkedIn. So if you came in through LinkedIn, that's cool. But all of our previous meetups are recorded, and this will eventually be posted on our YouTube channel. So we will be posting this one, and it'll be right here. And yeah, so to answer your question, and we meet every other Thursday. So the next meetup is going to be on Thursday, October 8th at 4:30 Pacific time. Next meetup is going to be really exciting. We're actually going to go through a syndication. So everybody that's on our list for the email invite, you're going to receive a PPM, an operating agreement, an offering memorandum. So you got a little homework if you choose to do so. I want you to go through the offering memorandum, go through the PPM, go through the operating agreement. We're going to go through the deal together. It's a deal that we own, that we've already closed, and we're going to talk about what you should be looking for and sort of how this deal is structured. And we're going to just dive right into if I was looking at it myself as a passive investor, what would be some things that I would look for? And you'll have an opportunity to look at those documents ahead of time, so you come to the meeting fully aware of what the deal is. So really looking forward to next week. It's going to be pretty open and interactive, and we're just going to talk about a real life syndication. It's a self-storage facility, and it's going to be a little bit of a collaborative session where we go through again, all the offering docs, the PPM, the subscription agreement, all the processes that went into doing that offering, so that when a live offering comes, you kind of have your repetition of maybe the things that you would look for, and better understand in a syndication. So, any other questions? We're almost to the end, so we do an hour every week. Any questions to kind of wrap it up? Closing comments?
Yeah. Hey, Ryan, actually, one more question.
Sure.
So in terms of, like, for example, raising capital for a syndication like yourself, do you have sales reps or anything like that? Like, is that something that makes sense, or is it more just website type traffic you drive, bringing it in?
Yeah. So what we do is, I'll share my website here. When you go to our website, we have a intake form. So sorry, it's a little bit slow to load tonight, but we've got an Invest Now button, and we do an investor intake on our website. So if somebody wants to, finds us, and funnels through our site, they can put their information. We collect just some basic information on them, and then this the investor on our distribution list. From that point, we get an email, we get alerted. Our investor relations team, we have 3 people on our team, myself, Ted, and Lauren. And so we get that lead, and then we follow up with an email and schedule a call to learn more about the investor, learn more about what they're looking for, and start the pre-existing relationship requirement if we were to offer that investor a 506B offering later. So yeah, we have a high touch process. I do know some groups that only do accredited investors. They have a high internet presence. It's kind of low touch, a lot of online advertising or content, and that's how they get their investors. So it's really just a lot of different ways you can do it. Does that answer your question?
Yep. Yeah. 100%. Yeah. I was just curious on like how it's all new to me. So just curious on how, the process goes, the legalities of it and whatnot. Because I know like RIAs in the past, they could also bring clients, I'm assuming too.
They can. Yeah. And, it's, for us, it just, every group is a little bit different. And, everybody, some people have heavy online presence, some people have high touch. So yeah, it just runs the gamut. So. Well, all right. Any final questions or thoughts? Maybe we could do this in person soon. I hope we can.
I think we will. Just today, the government released some more news for lifting restriction on business gatherings. So they allow more people to get together. So it seems like it's going the right direction for the corporate and other businesses. I think we'll make it happen. I don't know, maybe we'll be a little cautious for the next few weeks, but we'll see. I think just a matter of putting it on the books and just getting it done.
Absolutely. Well, I think we're going to go ahead and wrap up for tonight. Thank you, everybody, for coming. Again, the next meetup is on October 8th. We'll send out a invite with the case study materials, and we'll go through the case study on the next meetup. So feel free to do homework or not. You'll learn a ton anyway when you show up. You won't miss out anything. It's just for your benefit to kind of read ahead. And thanks, everybody. Have a wonderful night.